Good morning. My name is Leah Kratz, and I'm one of the authors of your financial accounting textbook. As you know, Chapter 12 is all about investments, and in this particular problem, we're talking about your uncle and the hardware store that he has. Your uncle made an investment in another organization and wants some information about that. Now, investments are a fascinating topic in accounting because we have so many different methods that we could use to record and report that. Unlike other assets, we have one, maybe two options available to us, and even in those instances, the options are used only occasionally or very rarely. But with investments, we have many different options and they're used all the time. So let's take a closer look at what some of these options are. The first one, if you recall, that we discussed are equity investments, and that's when an organization acquires the stock of another company. GAAP requires that equity investments be reported at their fair value or the market value at the time of reporting. If there's been a change in that fair value, any difference is reported as a gain or a loss on the income statement. Another option that a company has for investments are debt instruments. And in this case, when a company invests in the debt instruments of another company, we have to classify them based on the company's intention or the investor's intention. If the investor is intending to hold those investments for a short period of time or sell them quickly in the future, we call those trading securities. Trading securities are actually handled very similar to equity investments. They're reported at fair value, with any changes in fair value being reported as a gain or a loss on the income statement. But if a company invests in the debt instruments of another company and intends to hold them for some unknown period of time, sometime in the future, we call those available for sale securities. And that classification changes the reporting ever so slightly. They are still reported at fair value, but instead of those changes being reported as a gain or a loss on the income statement, it's reported at fair value, with those changes being reported in accumulated other comprehensive income. The reason being is because the future sale date is some point in the future which is unknown, and those market prices could vary quite a bit between now and the time they sell. So we don't want to recognize those as gains and losses on the income statement just yet. Now, going to the opposite end of the spectrum, when a company invests in the equity securities of another company, they could acquire such a significant amount that they actually have control of the other company. In those situations, we require at least 51% ownership to gain control. That's what the US GAAP has determined control to be, 51% or more. And when that situation happens, we have what's called a business combination, and a whole new set of rules come into play because the financial statements of both companies now have to be consolidated into one. And we have a whole set of procedures that we use to consolidate the two operations into one set of financial statements. Again, this is a business combination when 51% or more of the outstanding shares have been acquired. Now, in the case of your uncle's hardware store, there was an investment in another organization, and it was more than just what an average investor would commit to. Your uncle actually acquired 35% of the stock of another organization. And in this particular instance, that level of investment gives your uncle the ability to apply significant influence over that company that's invested in. In the US GAAP regulations, we define significant influence as being anywhere between 20 and 50% ownership of an organization, When that level of investment occurs, it's said that the investor can apply significant influence in the other company, and therefore a new set of rules apply in the accounting and reporting of that investment. And we call that the equity method. Now, the equity method is very unusual and unlike most anything we have seen or talked about in accounting so far. Under the equity method of accounting, I really like to explain to my students that we have to think about what's happening to the company that is invested in is also happening to the investor. So in this case, your uncle acquired 35% of the stock of another company. Now let's say that company he invested in earned $40,000 profit. The company that he invested in will report that $40,000 profit. But at the same time, because your uncle has significant influence, your uncle will report a proportional share of profit in his own company, in the hardware store. So 35% of $40,000 is $14,000 profit that your uncle will report as soon as the company he's invested in reports their profit. Now this is very unusual because your uncle didn't actually gain anything or receive anything, yet your uncle is going to report a profit. That's very unusual and unlike anything we've seen anywhere else. But that is part of the equity method of accounting. Now that leads us to yet another question. When companies invest, one of the things they hope for is for a dividend. So what happens when the company your uncle is invested in distributes a dividend? From here, we need to think about what a dividend actually is. A dividend is a distribution of wealth. And when a company declares and pays a dividend, the value in the amount reported in retained earnings goes down. The equity of the organization decreases. So when that company distributes a dividend and your uncle receives the share of the dividend, this is going to be reported very differently. It's not revenue for your uncle. To report a revenue or a profit from that dividend would be double counting it. Remember, your uncle already reported the profit when the company reported their profit. We do not want to have double counting of revenue or profits. So in this case, that dividend that's being received is going to mirror what's happening for the company that's distributing the dividend. Remember, the dividend's decreasing the equity because they're distributing the wealth. So your uncle is actually going to decrease the investment account. Again, this is very unusual. Cash is received in the form of a dividend for your uncle, but it will actually decrease the investment. So the things that we would really want to communicate to your uncle from this is the knowledge that because he acquired so much, which is 35% of the stock of another organization, this qualifies him to apply the equity method of accounting. And under the equity method of accounting, when the company he's invested in earns a profit, he will recognize a proportionate share of profit. And when the company he's invested in distributes dividends, he will actually decrease his investment account for the dividends that are received, so as not to double count revenue or profit. Again, investments are a really interesting topic in accounting. We have lots of different methods at which we can account for investments based on our intentions and our level of investment. I hope that you've enjoyed this chapter. I hope you've learned a lot, and I hope it makes you excited for the things that are coming. Have a good day.